To dollar cost average or to not? This is an age-old investment question, and we've been getting it a lot recently from our clients. So what's the answer? The answer is, as with most financial planning questions, it depends. Now let's explore why that is. For those not familiar, unlike lump sum investing, in which all available capital is invested up front, all at once, dollar cost averaging spreads that investable capital into installments that are invested over time. The appeal of dollar cost averaging comes from the perception that it allows investors to diversify their cost of entry into the market, buying shares at prices somewhere in between the highs and lows in a fluctuating market environment.
What are the implications? Let's take a look at a hypothetical example.
For this example, let's take an investor with $12,000 in cash earmarked for investing in stocks. Instead of buying $12,000 in stocks today, an investor going the dollar cost averaging route buys $1,000 worth of stocks each month for the next 12 months. If the market increases in value each month during this period, the dollar cost averaging investor will pay a higher price on average than if investing all up front. If the market decreases steadily over the next 12 months, the opposite will be true. While investors may focus on prices paid, it's important to remember that unlike with lump sum investing, a meaningful portion of capital is remaining in cash rather than gaining exposure to the stock market. During the process of deployment in this hypothetical example, half of the investable assets on average are forfeiting the higher expected returns of the stock market. For investors with the goal of accumulating wealth, there is an opportunity cost.
However, despite the investment drawbacks of dollar cost averaging, investors may be hesitant to pull down all their investable assets at once, which is okay. From a behavioral standpoint, if it's too stressful to put all your chips down at once, then dollar cost averaging might be a viable strategy for you. Both theory and data suggest that lump sum investing is a more efficient approach to accumulating and building wealth over time, but dollar cost averaging could be a reasonable strategy for investors who might have otherwise stayed out of the market as a whole because of fears of a large market downturn right after a lump sum investment. So whichever strategy you decide to pursue, remember this: develop a plan and stick with it.